Hey traders, Jeff coming to you here on Monday, February 24th, 2025. Today I want to do a little follow-up on a trade that we talked about, it's been a few weeks ago, on Costco. And I'm going to show you how that trade played out. It stemmed from a 3-bar play. So I'm going to walk you through that process. And you can take a look at these. These setups don't only happen on daily charts, but they also happen on weekly charts, 2-minute charts, 1-minute charts. But the higher the time frames, of course, the more reliable they are. But I will kind of walk you through why this setup it can be really good when you're looking for an opportunity to get on board a slingshot or a continuation play. Bear with me, we'll get started here momentarily. All right, if you recall, a few weeks ago, we got myself and the room members in the Costco play. Start off with a bearish gap that bullied up in here. Wide range bar on volume typically kind of denotes where we think prices might continue. We talked about the 3-bar play and the fact that you have to have an inside bar. That inside bar cannot be any more than about 25, maybe max 30% the inside. Why is that important? Well, mainly because if it's coming back and engulfing this bar, what did have the bulls in control would now put the bears in control. What that really is doing is letting the weak hands out. And if they don't come out and that stock can stay at that level here, they've given them every opportunity. The moment, the nanosecond, it trades above the previous bar's high right in here, you enter the trade with the stop below one of the 2 lowest bars here. Now you can, on Costco, you can go a little deeper down below the moving average if it's there. But somewhere in here to that moving average, but not more than 50% at worst, because you want to be able to take the upside. What happened to that trade? Well, as you can see here, it did gap up here, had a pullback with the 992, pulled back to 980. Next day, it looked like the bears were in control of that. And in fact, those particular days, the market pulled back, and they were kind of in charge of that, right? And the definition of a topping tail is a tail that actually closes lower than 50%. The body closes lower than 50% of the bar. So in here, that may or may not have been a topping tail in a sense, but this definitely was. You had supply up in here at $1,000. It's also a recognizable number. It's like 900, 1,000, 1,100. Anytime that you are approaching numbers like that, you always want to take some off the table. You don't have to take it all. You have to take half. Take 10%, 20% off, just to lighten up that trade at those precautious areas where you get into the numbers, because a lot of times big traders, they won't sell at 996.82, they'll sell at 1,000. And so for that reason, it's a good idea to kind of parse them off. Day 3, boom, a continuation in there. And I'm going to show you how you can manage this out as well. And to be honest, I didn't get as much as it's taken out. We're going to show you here, but I'm going to show you, man, you could have taken some off here. Wide range bar on volume ignited into the $1,000 bar. I would have lightened up severely at that point. Next day, straight up again, very low inside bar, closed up near the top, about 10% of the candle wick. At that point, you're about 1,020, 1,025. Continuation, and here's your topping piercing bar. I think it went beyond that a little bit the next couple of bars, not by much, but it did go a little bit beyond. At that point, I would have exited out on this bar. Now, a couple of things you could have done on the trail part. Once you begin to hit these areas and take some profits off, if you drill down to the 65-minute chart and you look back at the day, let's go back to that particular day right in here. Let's call it Feb 3. Feb 3. And look back on Feb 3 here. What you could have done is trail the 9-minute or the 8-minute EMA. Now, how do you do that? We talk about this on the day trading side almost every day in our room. But a trail on this, let me show you where we would have got you out. Doing it the way that we teach in here, you actually would have been here. You would have made this. This would have been fine. Stop would have been here. Boom, boom. Stop would have been here. Using this trail, not that you take it off at this, but there's a certain way that you use the 8 period to manage it. I'll do that, maybe that seminar one day in here. You would have exited out of this trade at 1,070.83. You would have got a little bit bigger than the piercing bar up top. Again, the key is on management is not being so reactive that you take that first pullback when it touches the 8 EMA or the 9 EMA. There is a process, and the process that I use works out like a charm. You have to have your stop identified. And then once you start to move up, you have to let that thing touch that area and then let several bars go ahead and then move that stop. And if it comes down several bars, you can't use that. You got to do it when it pivots and has at least 2 bars. Anyway, I'll spell it out a little more in detail at some point here, but Costco would have been a fantastic play using that. Again, it all stemmed from identifying what we would call a 3-bar play. These patterns don't set up every day, and sometimes you want to make sure that you are making sure you're detailed on what you're looking for. Once again, wide range bars ignite, leave demand behind. The second bar is the key, and the third bar really. You don't want it to penetrate more than 25-30% of that bar max. The next bar maintains the same. You can go briefly under, but hold that 25-30%. The next bar, you want to take above that high. And we got in literally the penny. It touched that high in there, and you can see what happened to the trade. There's a reason why patterns work and why technical analysis work, because where money is and how it actually formed technical patterns, those things are repeating effects. They keep repeating themselves, and our job is to find those, identify those to the best of our ability, and be able to capitalize on them. Not like I said, you'll find these on 2-minute charts as well. Are they going to be as effective? Sometimes it'll take off and go. But no, they're not quite as effective as you're going to see on the daily chart, or maybe the 65-minute chart, or even the 15-minute chart. But if you're day trading on a 2-minute chart and you're going to take a quick punch, that's not a bad thing to do either. So anyway, look for these 3-bar plays. They are money. We actually call them money bar plays for that reason here. So hope that helps and kind of gives you some insight on how the footprints of money form these patterns and form these technical analyses, to where if we look where that technical is, money's formed, and that money is formed based on the thoughts of people, right? Big money. And then the goal is to be able to ride that big money. And there's no way to know that unless the pattern shows up ahead of time. So like anything, this is for illustrative purposes only. You want to trade this at your own risk and just use minimal risk. Maybe even paper trade it for a while to make sure it's working for you. No trade is perfect. Some perfect patterns fail, and then sometimes slop moves in the right direction. So you never know. But ideally, we're looking for patterns like this, and we gain that edge, that extra 2-3% of an edge, once we see this begin to form like this. Thank you guys. Enjoy the rest of your day. Until next time, full throttle traders, we trade what we see, not what we think. Good day.